So first is liquidity risk. So that is essentially having an investment, and then when are you able to access that investment? So that risk theoretically would be a liquidity risk. Many times that's going to be seen when working with private investments. You purchase an investment, and then you're mandated to hold that investment for maybe 1 year. In the case of certain evergreen private funds, or in a capital call structure, you may not have any access to liquidity. So what's the reward for taking on the reduction of access to your investment? That would be known as liquidity risk. Purchasing a bond that you choose to hold to maturity is going to be some liquidity risk, and not having the ability to access those investments. So there's just a few examples of liquidity risk.
Yeah, many people full and well understand market risk, and that's when a stock can go up or down, or this value of a stock goes up or down. Typically, when you're taking other types of risks, there are benefits provided on the back end. Inflation risk, and Rory, why don't you talk a little bit about this? I mean, it's something a lot of people know full and well in this environment.
Well, yeah, exactly. We've seen a massive increase in inflation over the last 12 to 18 months. That's felt by all of us as consumers in the U.S. economy. Inflation, meaning the cost of goods and services, has increased. You're seeing this evidenced by at the pump, and the price of gas has gone up. The price of food has gone up as well. So inflation risk, as it relates to your investments, is, are you producing a rate of return that will actually net growth for you when you factor in the cost of goods, services, and just normal lifestyle? So what we've seen is inflation has increased, so a higher rate of return might be needed to provide an after inflation type of return felt to you as a consumer. So with that inflation increasing, our government knows that we can't have a sustainable inflation of 6 to 8%. So we've been increasing interest rates to try to bring inflation down. It's taken some time, but we have started seeing some signs that inflation is starting to ease. But the risk as it relates to your investments is, yes, you might be able to get a rate of return, and we're going to talk more about how, because the Fed has increased interest rates, cash is yielding more. But if you're getting a yield of 2 to 3% in cash, but inflation is running at 5 or 6, over time, your wealth is going to be eroded, because the cost of what you're purchasing is superior to the growth of the investments. So that's how you should really think about the inflation risk associated with your investments.
Perfect. And it's typically why, when we're measuring a targeted return for clients, it's typically based on where inflation is, or the cost of living.
Exactly.
Interest rate risk. So for, I guess, back in the 80s, and many know full and well, interest rates were double digits, and CDs were being issued at double-digit returns. For the past 30 years up until recently, interest rates were falling. And as interest rates were falling, so were bond values. Now that we're in an interest rate rising environment, bonds also take on that interest rate risk, or they're interest rate sensitive. So if you were owning bonds or CDs that were issued when rates were 1, 2, 2.5%, and rates are now 3, 4, 5%, that bond is going to drop in value, which is why last year we saw bonds, fluctuate almost to the tune of what stocks were fluctuating. However, now bonds are being issued at a higher interest, and they could even be purchased at a discount. So in those circumstances, if you're buying a bond that was purchased at a discount and it's yielding 5%, the yield to maturity might be closer to 6.5%. Something to consider there. Rory, you have anything to add?
I think interest rate risk has been the most felt by consumers and investors. So interest rates have gone up, so there's some positives there. The yield that you're getting on cash or safe investments like treasury bonds, CDs, that we'll get into next, has gone up significantly. So you're going to generate more income and a higher rate of return from those investments. Some of the negatives of rising interest rates is going to be lending, what you might see in credit cards, but especially the focal point now has been on mortgages. You buy a house today, your mortgage rate is likely double than what it was 18 months ago. So the mortgages are more expensive for the consumer. And I think the middle bullet point that Jeff, you mentioned in your kind of overview says it perfectly. When interest rates rise, the price of bonds decreases. Why? Well, it's because new issued bonds are yielding more. They're going to be more attractive. They're going to garner more demand. So if the demand decreases for an existing bond that was purchased a year or two ago, only yielding, say, 2, if new bonds of that same issuer are yielding 4, the demand for new bonds increase, the demand for those existing bonds decrease. Simply supply and demand, back to old economics. In contrast, when interest rates decrease, bonds increase, right? That's what we experienced leading up till last year. We now got to feel the effects of a rising interest rate environment and how that is affecting existing bonds. Really good for new issued bonds or new issued CDs or certain assets. But if you're holding existing bonds, you felt that pain. Good news is, as we talked about our Bond 101 video that you can also see on our YouTube channel, is if you're patient, you will see that bond price recover as those bonds get closer towards maturity. But what we are in now is a vastly different environment for some of those safer investments that are now able to generate a decent return. So we're going to dive into more of that. But this is a great opportunity to reevaluate cash, reevaluate your bond assets and your bond portfolio, because we have been through a massive, really a historical increase in rates in a very short period of time. Hence the need, I think, for this discussion.
Thank you for watching our video. Please remember to subscribe to our YouTube channel. Look at our links below for ways of getting in contact us, and message us if you'd like us to add you to our monthly newsletter.